I think our forecast overall is slightly more optimistic than what Commissioner Gentiloni has just outlined. We have a slightly shallower recession and minus 8.1 this year, and a bit more of a bounce back next year, so 6.5%. But I think the fundamental point that Gentiloni hinted at, which is the biggest challenge here for Europe, is how do we navigate through this transition? Gentiloni has rightly highlighted that the economy will be different coming out of this crisis. There are social distancing measures still in place, behavior might change, and a lot of the tools that particularly Eurozone countries have put in place so far, short-time work compensation scheme, guarantees, what they're really good at is at freezing the current economy and reducing the cost of the lost economic output. But they're not very good at managing the transition. In fact, they could actually counteract some of that, because as a consequence, we could see, for example, some zombie firms continue to receive capital from the banks, or being allowed, for example, to remain in life. So I think this is really the key challenge, how the Eurozone uses some of those tools and changes some of these tools in the second half of the year and the first half of next year to try to manage this transition. And that's really what could drive the bounce back of the economy in 2021. And I think, as Gentiloni highlighted, really the Next Generation EU Fund could be an important driver of change here. But we also know that there are significant challenges. For once, that it still has to be agreed, and we're looking forward for the negotiation next week. And second, also implementation could be tricky. It might take a lot of time to actually get the money out of the door.
Fabio, I think it was very interesting to hear some of this commentary, in the sense that it was aligned with the market, where there is an assumption that you lock down these communities, very locked down in some cases, and you start to lift the restrictions, and then we just bounce back to some of the pre-COVID activity. That's not been the case, and that was highlighted in this report, that the lifting of lockdowns hasn't proceeded as swiftly as one would have thought. Also, some of the assumptions, even around the new forecast now, suggest that it assumes there is no second wave that triggers renewed restrictions. Sure, it can account for some social distancing, but not renewed restrictions. And already we are seeing communities going into lockdown because some hospitals are reaching capacity, at least in the United States. If we see a situation like that in Europe that spirals from where we are, how concerned are you that some of the assumptions on economic recovery will have to be reduced even further?
Yeah, so I mean, certainly the way the lockdown has been lifted has been different than what we had initially expected. And that's been an important factor in terms of revising down growth for this year, and also reducing the extent of the bounce back, because we still have what we call lingering effects. So on the one hand, people are scared that they don't want to go back to do the same things that they were doing before. And on the other hand, we have social distancing measures in place to prevent a potential outbreak of the virus again. And so those lingering effect is what is weighing on output at the moment. And we expect that they will continue to weigh on output at least through the first half of next year. And that means that, economies that are particularly exposed to the restoration, accommodation, services sectors, so some of the sectors that are particularly affected by some of those lingering effects, could suffer even more. So that means that countries like Italy or Spain could see a slower bounce back in terms of economic output than, for example, a country like Germany. Now, on the other hand, as you rightly point, there is a big elephant in the room here, that I think everyone is working on a baseline assumption where there isn't a second wave of outbreak in the second half of the year. But at the same time, we keep hearing of pockets coming back in the north of Italy, more recently in the north of Spain, Lisbon, in Western Germany. So there are instances of the virus coming back. And of course, that makes us and investors worried about the possibility that we might see a second wave of restrictions in the second half of the year. Our view in general on that is that, of course, this is possible. It's well beyond our understanding as economists. But in general, we think it's unlikely we're going to see the same extent of restriction being in place. Also because I think, what we learned through the first wave is that probably countries that took very far, like Italy or Spain, closing non-essential economic activity, that didn't have a major impact in terms of reducing the extent of the outbreak. What really seems to have worked is more testing, sort of controlling the number of cases. So what we expect to see is that probably there will be more focus on those type of interventions rather than full lockdowns of the economic activity. Having said that, of course, that means that there is a substantial downside risk to the forecast scenario that I previously outlined, and certainly what Commissioner Gentiloni has also been describing.